Okay, good morning, everybody, and welcome to this week's webinar, where I've called it "Dude, Where's My Trend?" I was going to go for a much more sort of serious title there, but I thought, this will appeal to the viewers. So something a little bit different there, but rest assured the content is extremely serious. Some of the stuff that we're going to talk about today, and I've got quite a few slides to get through, so it's completely possible that we might need to do this over two separate sessions. But we'll see how it goes. But basically, what I want to talk to you about today is one of the primary reasons that, retail traders do fail in the markets, what you're doing wrong and how you can go about basically fixing that and taking the path to actually getting into the moves before they happen rather than talking about them after they've happened. Because I'm sure we've all been in that situation where, morning 80, I'm sure you've all been in that situation where you've looked at a chart, you've seen an amazing trend, you've then sat there and thought to yourself, well, it looks so easy with hindsight, obviously with the benefit of looking back in time, I can pick the entries really, really easily, but obviously knowing that that's going to happen at at the hard right edge of the charts, knowing that that's going to happen before time is obviously a hell of a lot more difficult to basically do and to come up with. So in this webinar here, I'm going to show you exactly why that is and exactly how you can go about changing your trading today. Now, the one thing that I will say up front is that I know there are going to be a few of you out there that are going to find this extremely boring, all right? But I do ask you to please bear with me because the content of this is going to help you in the long run, I promise you. All right, there's a reason that the majority of people, the vast majority of traders fail to ever make money in the markets. You're going to see that right here, right now. A quick disclaimer though, the content of this webinar is not investment advice, okay? It should be used purely for educational purposes only. All participants are advised to seek their own counsel prior to investing or entering into any trade. Spread betting and any other type of financial trading carries a high level of risk to your capital with the possibility of losing considerably more than your initial investment. The content of this webinar may not be suitable for all investors, and an individual should ensure that they're fully aware of the risks involved and, if necessary, seek the advice of an independent financial advisor. Hello, Oscar. How are you? Thank you for your email the other day, by the way. So a little bit about myself for those of you that don't know me. I've been trading and investing since about 2005. I co-founded Traders Corner in 2010 with my brother, and since then we've taught just over 8,000 traders. And what that is obviously not face-to-face, but for our strategies and things like that. We publish our analysis on various financial publications. We've co-authored 3 trading books, and we've been the guest speaker at various trading conferences and exhibitions around the world. One coming up this week. If any of you are at the Traders Expo tomorrow even, then I look forward to seeing you there. I'll be talking about this stuff on stage tomorrow at about 4:20. I also present a popular weekly trading YouTube Forex analysis show, and you can find me on Twitter, AlexOnUK. Okay, enough of the self-promotion. Let's get on with the good stuff. So most retail traders trade with hindsight, okay? And this is very different to how professional traders approach the markets. Retail traders will pull up a chart and they'll find a long-term trend in a stock, currency or commodity, and they'll mark out these beautiful, pretty support and resistance lines. They'll put amazing indicators on it, and they'll sit there and say, oh my gosh, what a great trade that was. Why was I not in it? Okay, that was an amazing trade. It was easy to pick out, but they don't make any money from it. Or they mark up their charts and they put, again, all of these pretty colors, and they end up identifying trades right at the end, after we've already been in those trades. Retail traders don't make any money from these moves. What they do, as I just said, so they actually end up selling after a massive move or buying after a massive move and then getting stopped out and wondering why that happens. Professional traders are the people that are identifying these big moves before they even happen, and they invest before everybody else. And this is the main difference between the retail and the professional. Retail traders are always, they're looking for the confirmation. Okay, they're looking to make sure that, the Mars aligns with Venus and everything marries up, and then they get into the trade. And by the time all of this comes to fruition, by the time everything confirms your trade, you're already late to the party. You've already missed the major moves. Okay, so retail traders, which is why we call it this, retail traders trade with the benefit of hindsight. Professional traders trade with an expectation of what future moves are going to show. Gino, I can post you a link to our YouTube channel in a little bit. Okay, I'll do it at the end of the show, at the end of this webinar here. So here's an example. Okay, here's an example of one of those traders. Throughout October and November of this year, they've marked up a channel there and they've said, look at this amazing downtrend. Okay, descending channel favors further USD downside. Okay, amazing. Only that was at the bottom of a move that started, before last year, when it started up at 140. We went on camera, we went on to a show in September of last year at 127 and said that the market is going lower. So whilst we've been selling the euro dollar for like the last 18 months, retail traders come to the party and they end up posting something like this, looking to take a trade, then wondering why when they get into the trade, depending on where this person's stop was and where their profit target was, they would have been stopped out of this, most likely. Okay, after what happened last week with the ECB and the ISM coming out and basically contracting for the first time in forever, they obviously would have been getting into this way too late to the party, and they probably would have lost money on this particular trade here. Again, depending on where the profit target is, but you get the picture. This market has moved a long way. This downtrend has been in place for the past year, 18 months. We've been selling for the past year, 18 months, and retail traders only pick it based purely on the technicals without taking into account what the fundamentals are behind it and what's driving it. So as I said, 15th of November, the retail trader on Twitter posted a perfect hindsight chart with trend lines, two great trades. The price was 1.0725. Where is it trading today? Let's go take a look at your euro dollar charts there for a minute, okay? So 1.0872. It's not as easy in real time, is it? But as I just said to you, we had this expectation of the decline when the euro was trading at 135. And we went on camera and told that to the world in September 2014 when it was trading at 127. We said it's got further downside to go. Where does it go? We don't want to catch a falling knife, but we do believe that it's going lower and a lot lower. And we gave our fundamental reasoning behind that. Here's another example. This is a stock chart, okay? And I'll tell you a little bit about this in just a second. But you can see here, this is a stock chart. Someone posting on Twitter, fossil sitting new lows, technical chart always tells a fundamental story. Really? So they're posting this chart at 52, indicating that you want to be going short. We, on the other hand, okay, we were looking at this stock back in March, okay, when it was trading at 85. We sold it at 75, then we sold it again at 63. And the stock's now fallen to 52, which is where the retail traders late to the party yet again are identifying a trade and saying, look at this great trade, look at this great short. Are you starting to see a pattern here? So by looking at the charts, yes, you can pick out good trades. Yes, you can get into, great technical trades. But if you want to be getting into the big trend before it happens, you need to be looking at something other than just the chart. We got our idea from the Institute of Supply Management, which is a freely available report that's released every single month, okay? And basically, in that particular report, we were alerted to the fact that the industry for apparel, leather, and allied products was in contraction. So we then went and did our analysis. We found a stock within that particular industry there that we thought we felt was weak and would continue to weaken over the coming weeks and months. And that's when we identified fossil, and we sold fossil way higher than the retail market did. And then finally, for the examples, we've got one here of the Australian dollar. The Australian dollar, we've got a really beautiful, pretty chart here with lots of red lines and yellow moving averages annotated to the hill, saying that we're awaiting confirmation that the downtrend in the pair is complete. The move so far has looked corrective. Well, the retail trader posts this chart on the 3rd of September when the Aussie dollar was trading at 0.7000. Lovely colors, as I said. I'm not taking anything away from that. Aesthetically extremely pleasing. The Aussie dollar fell below 0.700 temporarily, but is now trading at 0.7200. Again, much easier with the benefit of hindsight. However, the entire Australian dollar move could have been anticipated. You can forecast that if you understand the relationships between the different currency pairs, between different stocks, and the fundamentals that sit behind it. So if you understood that the Australian dollar was a commodity currency, okay, and it closely follows iron ore prices, you would have been tipped to this particular trade here when iron ore started to fall off an absolute cliff. So it broke structure. Okay, broke structure over here, broke through that level there, and with some momentum broke to the downside. You don't even have to be, right on this in the day. This is a couple of weeks later. The market then broke structure on the Aussie dollar, and when it broke structure on the Aussie dollar, you then get the opportunity to go short. Okay, so do you see how by taking a bit of a broader look at things rather than just focusing on the charts and looking at other information, which I appreciate. Most retail traders do not want to look at this information. They find it difficult to put all of that information together. It is daunting in the beginning. I completely appreciate that. But if you're willing to put in a little bit of effort, I promise you it's nowhere near as hard as you think it would be. Okay? And you can predict moves, you can forecast moves way, way, way ahead of the actual moves themselves. So as opposed to someone that may have lost money, if let's say you were trading the euro dollar over the past year, if you traded according to your fundamental bias, all right, you would be taking trades in the direction of the trend. You would have eliminated, half of the trades that probably lost you money. Does that make sense? So, as you can see, it's common practice for retail traders to find a big move in the market after the event. All right, highlight the potential entries that could have been. Okay, or even buy or sell after it's too late and ending up losing money. Does that make sense? That's what you guys are all doing currently. All right, and we can basically eliminate this retail trader approach by applying context and using economic data to forecast market moves before they happen. So how do we do that is a big question, right? We've said to you that if you look at the fundamental data, you take a little bit of a step back, then you can get a view into the future. You can forecast what's about to happen. With the business cycle, all right, which is one of the key components of where an economy is going, and if we understand where an economy is going, then we understand where everything else is going around it. All right. And for anybody that hasn't heard of what the business cycle is before, basically the business cycle gives us the context that we need, okay, to be able to make trading decisions. The business cycle is simply phases of expansion and contraction in an economy. All right. So the economy goes through cycles. Every sort of 7 to 10 years, you're going to see boom and bust in the economy, right? So you'll see a country go through a period of prosperity where everything's expanding, everything's growing, people are doing well, and then it will go through a phase of contraction where things start to tighten, consumers start to struggle a little bit, and ultimately this is what you see as a recession. And the business cycle basically gives us this context. So understanding the business cycle is a critical way of determining stock market and sector and currency performance over the medium term. We break down the business cycle into 5 phases. Each phase has its own characteristics and therefore favors certain sectors, stocks, and currencies according to the different phases. The first phase is the early expansion phase. All right, and the early expansion phase comes after contraction. All right, and it has the most robust performance in the whole cycle. On average, it lasts about 12 to 18 months and is characterized by low inflation, okay, easy monetary policy, and stock market returns of about 20%. During that phase of the business cycle, you'd be looking for things like sectors like consumer discretionary sectors, financials to be doing well, more defensive sectors to be lagging behind a little bit. So if you take a look at this chart here, if you were just to try and analyze where you were based on the business cycle, it's quite clear here that looking at some of the more defensive sectors, which you would expect to not do so well in comparison with one of the more cyclical sectors, okay, you can immediately identify that you're at a sort of growth phase in the economic cycle, because you've got something like consumer discretionary doing a hell of a lot better than utilities. And if you look at a stock within consumer discretionary, it's doing phenomenally. This chart here is over 18 months. So let's say, for example, you didn't even look at currencies. Let's say you just looked at a particular ETF, sector ETF, for example, and you knew that this was going to happen. That's a 54% return in 18 months. That's unleveraged. Imagine the sort of leverage you apply to some of your FX trades, and then look at what you could have made there with very, very little headache, whatsoever. And then if you're saying, okay, well, that's great, but I like currencies, so how does that apply to me? Well, look at this. The consumer discretionary sector, okay, is correlated extremely highly to the dollar yen. So understanding the business cycle, for those of you that are almost switching off at the moment, look in front of you. There's a currency chart right in front of you. And I'm showing you how the business cycle can help you anticipate moves, okay, in the currency markets. Right? And I don't mean to come across as being, condescending or harsh or anything like that. I just want you all to be successful. And I know that there will be people there that are sitting there thinking, oh my gosh, what are we talking about here? No technical analysis, not interested, switch off, let's go look at something else. But this here is real money. This is going to take you on to the next level. The next phase of the business cycle is a mid-expansion phase. This phase is characterized by supportive monetary policy. Okay, so still low interest rates, still low inflation. At this phase of the business cycle, consumers, so think of people like yourselves, your confidence is improving, okay, as you're getting more secure in your jobs, you're getting more hours, you're being paid more, okay, so you're feeling better about your situation. Because you're feeling better about your situation, you're spending more, okay, and because you're spending more, company sales will continue to grow. Because you're spending more on the high street there, all of those companies, your Next, your River Islands, your Best Buys, etc., that will be reflected in their bottom line because you're spending more money. So during this phase of the business cycle, you're expecting stocks that are sensitive to improve consumer sentiment to start to do well, okay? All right, or continue to do well, rather. Leaders will be looking at things like information technology and industrials, laggards, more energy. Okay, utilities, some of the more defensives. Here's an example of such a chart. So you've got things like consumer staples lagging behind the industrial sector, which is what we would expect from this phase of the business cycle. Pick a stock within there, 80% return in a year, in under a year, 80% just for one stock, unleveraged again. How about we tie this to a currency? Well, up until iron ore started to fall off a cliff last year, this was extremely closely correlated with the Australian dollar. Okay, so commodity prices came down last year. Obviously, we know that the Australian dollar's massively correlated to iron ore prices as commodity currency, so we'd expect that breakdown there. But until the commodity prices started to drop off, you can see that just by having an idea on where you are in the business cycle and what sectors typically are going to do better during those phases of the business cycle, again, you can get a view on where the currencies are going. Make sense? So I've seen it written before in forums, and I've had the question, are there any correlations? Is there anything that we can use to tell us where something's going to go? Yes, there is. It's right in front of you, right there. Just apply the brain for just a little period of time, and you will find that your results will improve markedly. So the mid-cycle phase of the economic cycle is a little bit more of a difficult one to pick in terms of leaders and laggards, because generally every sector is going to perform well during this phase of the business cycle. It's the longest phase of the business cycle. It's the one that we are currently in. Okay, and it's characterized by stock market performance of about 12 to 17%, and the fact that there isn't necessarily one outstanding performer. Yes, there will be certain sectors that will do better than others, but really and truly, you will make money wherever you put your money. Okay? That's why when you hear about stock market millionaires and things like that, they don't necessarily have to know what they're doing. They're just getting into markets at opportune times. So they're buying in bull markets and they make money no matter what, pretty much. And here you can see these are all of the sector ETFs that we track there. Okay, so you've got like consumer discretionary, you've got energy, you've got technology there, healthcare, financials, utilities, industrials, consumer staples, and we've actually missed materials off here, but that should be on there too. And ultimately you can see that all of these sectors here are doing well. So wherever you put your money, you would end up making money. Okay? The final two stages of the business cycle, we have the late cycle phase, which is about 18 to 24 months in duration. Stock market returns during this phase are about 5%. Inflationary pressures will have been built up because we've gone through the early expansion, mid-expansion, mid-cycle phase where there's been a lot of demand for products, so prices will be pushing up. Okay, so inflation's pushing up. With inflation pushing up, you will then look at central banks looking to tighten monetary policy, right? Because they're trying to stop an overheating economy there. They don't want seriously high inflation, so they're increasing their interest rates. And when they're increasing their interest rates, consumers start to feel the pinch within their pockets because prices on the high street are higher. Interest rates are higher, so anybody remortgaging their mortgages, so anybody remortgaging rather, will be having to pay more money on their mortgages. So whereas, let's say, for example, the average consumer had, hypothetically, I don't know, £1,000 disposable income during a phase of prosperity, of loose monetary policy, suddenly, even looking at mortgage rates going up, they may lose 20% of that disposable income. Prices on the streets going up, they may be looking at another 10, 20%. So their buying power is nothing like what it was in the previous cycles. So they spend less money on the high street. And if they spend less money, that's reflected in the corporate earnings, isn't it? So it's one vicious cycle here. During this phase of the business cycle, you'd expect things like energy and materials to do well and consumer discretionary and information technology to not do so well. Okay, because consumer discretionary, things like that, these are the luxury items that you don't necessarily need. You only buy during a time of prosperity. A great example is the automobile industry. If you're doing well, if you feel confident about your economic future, you're going to put money into, you're going to buy that new car, you're going to buy that handbag, okay? If you're a lady or if you're a man, I don't judge, it's fine. I have a man bag. But you see what I'm saying? You're going to spend money on those luxury items that you wouldn't usually spend money on if you didn't have as much disposable income. During this late cycle phase here, a great example, if you're just looking at comparing the sectors, consumer discretionary down 5%, energy sector up 15%, unleveraged. Stock within the energy sector up 91%. Looking at a chart, if you believe the energy sector is going to do well, okay, if inflation's up, commodity prices rising, things like that, you look for a commodity currency to go and put your money into. You can see here that the dollar CAD is inversely correlated, because obviously for the dollar CAD, for the Canadian dollar to appreciate, the dollar CAD chart has to go down, right? So energy prices are appreciating, Canadian dollar will appreciate, dollar CAD goes down. Again, this is how you can take your cues from the business cycle. And finally, the final phase is the contraction phase. Okay? The contraction phase of the business cycle is typically characterized by corporate profits declining, monetary policy is going to become more accommodative. So you'll see central banks decreasing their interest rates, central banks entering into quantitative easing. Okay, inflation comes down. They're looking to boost the economy at this phase in the business cycle. Now, thankfully, okay, this is one of the shorter phases of the business cycle. So recessions don't last a lifetime for the most part. Where you'd look to make your money are things like the essentials. You'd think consumer staples, things that you have to buy, whether you like it or not. You still have to buy soap. You still have to buy toothpaste. You still have to heat your house, buy water, things like that. They are the last things to go, right? So they'll be the sectors that will fare best throughout a recession. Okay? And there is an example of that. So you've got consumer staples and one in blue. Okay, just down 5%. Industrial sector's down 18%. But if you found a stock within that sector there, Procter & Gamble up 7%. So that's the business cycle. Okay? They're the characteristics of the business cycle. Now, you're probably sat there wondering, okay, so I've got the business cycle here. I understood the first part where I'm going to, obviously, where I want to be ahead of the trend. So how does this help me do that? Well, understanding the business cycle will help you understand what the different correlations are within the market. Okay, so what's going to do better at different phases of the business cycle? You know, whether it be a currency, a commodity, a stock, or more broadly speaking, a sector. What will do better? All right, so how do we forecast the business cycle? The answer to this is leading indicators. Looking at fundamentals. The stuff that we all hate to do, right? How many people here actually look at fundamentals? I'll guess not too many. And if you do look at fundamentals, I would imagine you go to the Forex Factory or Daily FX or FX Street Calendar, right? And you would look at, I don't know, you'd look at the headline numbers, but you'd look at the red items on Forex Factory. So you'd look at GDP, you'd look at retail sales, you'd look at the non-farm payrolls. Am I right? When you're looking at fundamentals, that's what you look at. Okay. Now, even though these are important, what would you do if I told you that by looking at these indicators here, you're already late to the party? Tools. But you're looking at the wrong ones. As professional traders, we want to be forward-looking. So we're not looking, we do use those economic indicators. We do take down that information, but only to confirm our view. Okay? We're looking at leading indicators. We want to forecast what's going to happen, as opposed to report on what's already happened. You see, as professional traders, okay, what we're looking to do is get ahead of the game. Retail traders, they'll look at, GDP as one of their favorite economic indicators. A strong GDP number comes out, means that they're going to go and buy it. Bad GDP comes out, they'll sell the market. GDP is one of the most lagging indicators you can find. fundamentally. GDP is absolutely reporting on what's happened. Professional traders are trying to forecast where GDP will be. Okay, so we're forecasting that big number rather than reacting to it. Professional traders understand that GDP is correlated to the stock market. So the stock market's up, GDP will more than likely be up. GDP's up, you'll see risk currencies doing well, growth commodities doing well. So if we can somehow find an expectation as to where GDP is going, we'll have an idea on where the stock market is going, right? Manoy, in terms of saying you think that the arguments that retail traders has the same charts as the pros, but in terms of fundamentals, you're at a disadvantage in terms of resources, that's actually not true. It's absolutely not true. All of those indicators, all of the fundamentals that we look at, they're all freely available. You can actually go to the reports themselves and you can read them. The problem is that retail traders don't read them. Does that make sense? Retail traders will just read the headline number and not look into the reports themselves and not try and understand what the report is telling them. They'll just trade the number itself, looking to make money off of the reaction. So we look at leading indicators. Okay, we use three different sort of areas of the economy that we look at. We look at the consumer, we look at business, and we look at the housing market. That simple. All right. Now I know that I don't have very much longer left, so I'll try and rifle through these so that you get a good idea as to what it's all about. In terms of the consumer, in order to successfully forecast US GDP, we have to have an idea of the health of consumer spending, right? Because the consumers make up a portion of the US economy. Okay, it's approximately 70% of US GDP. So logically, if you think about it, if the consumer is happy, healthy and willing to spend, okay, then we can expect them to spend. And this will result in economic growth. Likewise, if the consumer is feeling really pessimistic, they've lost their job, they're not getting paid as much, their hours have been cut down, they're not going to spend as much money. And this will then be reflected in the wider economy. Okay? So from a consumer's perspective, we look at two indicators. Okay, we look at the CB Consumer Confidence Indicator, which is a mail survey of about 5,000 people, and 2,500 will respond to it. And basically what this survey does is it gives you sort of like an index, okay, where if the number is between 100 to 120, you're expecting about a 3% increase in GDP. Growth, that is. If it's in the blue sector, 80 to 100, you're looking at 2 to 3%. Orange, 0 to 2%. And anywhere in the red, you're looking for contraction. All right, and taking a look at this chart here, you can see that every time, more or less, the CB consumer confidence dips into the red zone there, it's followed shortly after by a recession. Okay. One of the other areas that we look at is the University of Michigan Consumer Sentiment Index. Okay, this is a telephone survey of 500 consumers. Again, you get sort of like an index, you get a level that is historically been correlated to GDP. So a level above 80%, 85 indicates a 3% GDP growth rate. The long-term average is that 85 equals 3%. Okay, so anything above that, we're in a healthy economy. Anything below that, we need to be a bit cautious. Anything that drops below 70, well, we know that we're in for tough times ahead. And here you can see that the University of Michigan survey leads GDP. Okay, so when the UOM comes out below the red zone there, okay, you can see that GDP follows afterwards, goes into contraction. We have a recession. The other area that we look at is the business. So we understand what the consumers are doing. We then need to understand what the businesses are doing. Okay, because ultimately, the businesses, their perception on where the economy is going will have an impact on the consumer. Because if the businesses are positive, they're going to spend more money, okay, on staff. They're going to hire more staff, pay more wages, which will in turn affect the consumer that we just spoke about, right? And then if the consumer's feeling good, they're then going to spend more money. That will then be reflected in the balance sheets of those companies, and the economy will be doing well. So as you can see, it's all very, very logical here. None of what we're doing is rocket science. Okay, so if businesses are growing and doing well, this will then be reflected in the stock market. So to gauge where businesses are, we look at the ISM manufacturing and non-manufacturing. Okay, this is basically a survey of 300 purchasing managers. Okay, and basically they give us a very, very comprehensive report, something that the retail traders will only look at the headline number. Yes, we look at the headline number because it tells us, it gives us sort of like a broad view on whether an economy is expanding or contracting. All right, but there's actually a lot more to it. It gives you specific trade ideas if you dig into the report itself. And if you look at the ISM here, the ISM is the red line, GDP being the blue line. The ISM again leads GDP. Okay, so this again is going to tell you where you are in the business cycle. And if you know where you are in the business cycle, you know where to put your money, what currency, what commodity, what stock to put your money in, if you understand this ahead of time. And here's an example of one of those reports. We showed it a little bit earlier because it's how we found our fossil idea. Okay, and this is a great example of how the retail trader is always late to the party. So this is a report back in August where we get told ahead of time, and you guys have access to this as well. We get told ahead of time that electrical equipment, appliances and components, and computer and electronic products are going to contract. They're not going to do so well in the next few months because it's forward looking. All right, it's not reporting on the past, it's looking forward. However, for the retail traders that will be looking at, the red news and reacting to the red news, they'll be looking at the retail sales reports rather than digging into the Institute of Supply Management report itself. They'll look at the retail sales and then they'll trade according to that. Last month's retail sales, okay, so for November, reported that there had been a slowdown in electronic stores. Isn't that a huge surprise? Well, not to us and not to you once you finish this webinar, because you will now know where to go and look for these things to put yourself ahead of the game. So you will know about this a quarter before the street reports on it. Okay, and here's an example of a stock. This is a random stock. We didn't even get involved in this. We just picked this random stock here to say, even if you closed your eyes, even if you were complete crud at looking at this information, okay, as long as you could figure out where to put your money, more often than not, you're going to be able to make money. Manoy, in terms of saying it's hard for one individual trader to have the time and energy to do the sufficient fundamental research, it's actually not. As I said, we only really look at 3 different areas of the economy for the most part. And it takes us probably a day a month to stay up to date with things. Oh, what have I done here? Okay, so the ISM has a manufacturing and it has a services report as well. The services report hasn't been going for as long, but it is still very closely correlated. Okay, 80% of the employment in the US is service-based, so it's a good idea to have an idea of what the services report is saying as well. And it's very, very similar to the manufacturing one. And as you can see there, they track each other really quite closely. Okay, so for the most part, where the manufacturing goes, the services will go, the non-manufacturing will go, up until today, where we're seeing a bit of a divergence there. The final part that we look at, okay, is the housing sector. Because if you think about it, the housing market is very, very important to the US economy. All right. And due to the subprime housing crisis, the data there has grown in even more importance. And it's a very good leading indicator of the business cycle. We look at two housing reports. We look at the National Association of Home Builders, okay, and they produce the housing market index each month, which basically gauges builder sentiment. Okay, so it's looking at the demand side of the housing market. And what ultimately it's looking at is it's forward looking. So it's looking at the current sales, what's going through currently, what's their expectation for sales over the next 6 months, and what's the traffic of buyers coming in to look at new homes, even though they may not have purchased it. Because if you think about this, why is the housing market important? Think about it logically. You're only going to go and buy a new house if you have the additional income to facilitate that. You're only going to be able to buy a new house if the financial market is stable and healthy so that you'll be able to get a mortgage. If the banks aren't lending, the housing market is going to deteriorate, right? So by the very function of the fact that home sales are going through, that means people are getting mortgages, which means they're more confident about their outlook. Okay. And it also means directly that the financial market is looking pretty healthy as well, because if it wasn't, the loans wouldn't be there for the consumers to be able to go and buy those new houses. Okay. The last thing we look at is the CB building permits. Okay. The CB building permits is an index that comes out, and basically it tells us what what permits have been granted, what's been put in from the home builders to be able to go and begin new projects. And if you think about it again, logically, the home builders aren't going to go and pay for something. So they need to pay for these permits. They're not going to do that if they don't think that the economy is expanding, if they don't see demand in the economy for new houses. Okay, and this index here, it comes out, gives you a number. Above 50 basically means that the builders believe that the conditions are good. Below 50 means that the conditions are poor. Okay, and it's very, very closely correlated to the CB building permits. And as you can see here, when the market goes below 50, the economy, okay, so GDP, this bottom one here, takes a downturn. When it moves above 50, GDP then moves up. Okay. Now this here was just a very, very sort of brief, I guess, run through, because in all honesty, this can take us to go through it in a lot more detail. It can take significantly more time. So I can't do it in 45 minutes, but hopefully I've given you enough information here to go away with and sit there and think to yourself, oh, actually, I should be looking at a bit more, because this right here, you know, this stuff can help you predict where things are going. If we go back to those initial slides on how we got involved in those trades there, it was based on this information here. Okay. So when we got involved in the euro dollar back when it was trading at the 130s, it was because of this information here, because it was forward looking. The two trades that we took on fossil this year, when it was up at 85, selling down to 75. Okay, it was because of this information here. Does that make sense to everybody? Are you all still alive? Has everybody gone? They're like, damn it, this is too much. I'm going. This is the end of it. I don't care. How do you explain the current situation in the euro dollar showing a rational divergence between fundamentals and technicals? Euro continues to be one of the weaker major currencies fundamentally due to the active easing cycle by the ECB, yet exceptionally rallied against the US dollar going into the No, it rallied against the dollar last week. Okay. So we're coming to the end of it here, but I'll quickly answer the question. So it rallied against the dollar last week because basically the market were expecting a lot more. Okay, a lot more QEs. They didn't basically, the market's expectations were more than what was delivered. Okay, so we were actually short euro dollar last month for the last month. Okay, we were short the euro dollar and we came out of it ahead of the ISM last week. No, well, Gino, in terms of forecasting it fundamentally, we were, as I said, we were already positioned for that, but we protected ourselves against things like buy the rumor, sell the fact, because we can't tell what the central bankers are necessarily going to come out and say, but we can trade based on the expectation. So we made money last month being short euro dollar. We didn't make, I thought it was going to go maybe 400 or 500 points. It didn't do that. We made about 200 pips in total, but we still made money based on that. No, Gino, the market is never just behaving technically with no fundamental reason. There's a lot of fundamental reasons for why the markets are behaving the way they are currently. The problem is that retail traders and technical traders they only want to look at the charts because it's easier to look at. But that's why, as I said, a lot of people lose money. But hopefully from watching this here, you'll be willing to put a little bit of context around things. Okay, well, we personally wouldn't be short currently. We're already out of our position. We closed at the beginning of last week. Oh, short term. Yeah, definitely. I mean, short term, it will behave technically for sure. Chris, yeah, we do 2 webinars a month with FX Street. It's not good to turn a short-term trade into a long-term trade, Gino. Manoy, in terms of a big bear market coming, we believe that we are in for some harder times ahead. We definitely believe that. In terms of when that comes, not too sure. We're looking at the yield curve and some of the leading indicators. The leading indicators are starting to point down a little bit. So we are expecting harder times ahead for sure. Okay, people. So how can you learn a practical method and routine to make this? If you drop us an email, Gino, I can give you a few tips and stuff. We do have a program where we're taking people through at the moment, where we're teaching them how to apply all of this to their trading. But unfortunately, that's closed right now. We're midway through a 3-month program. We'll be opening the next program in February. So if you're still interested then you're welcome to jump on board. Unfortunately, at the moment, it's closed though. No, Oscar, the point isn't that. The market reacts to NFPs in the very, very short term and things like that. Okay? The market reacts to retail sales for half an hour, an hour after the result. But in terms of the sort of like what's going on in the next few weeks, the next few months, that doesn't have as much of an impact as the leading indicators do. I knew that this would be a bit of a controversial presentation, to be honest with you. I knew that the majority of people here wouldn't necessarily see the point, but I was hoping that you guys would be open-minded enough to at least go back and watch this recording and take a look at some of these things, because I promise you it's going to help your trading in the long run. And I don't mean to sound harsh, but if you're determined to just sit there and look purely at a technical chart, then yes, you can be successful, but it's going to be a harder road for you, a much harder road. If you're willing to engage the brain a little bit and do a little bit of work, then you're going to find that your results as a trader will really, really, really start to improve. The recordings will be on FX Street, guys. So if you go to the webinars page on FX Street, they have all of the archives there. Okay. So that I've already gone over by 6 minutes. So apologies for that, FX Street. I didn't mean to sort of go into that so much. But thank you very much for bearing with us and giving us a time. And if this is interesting to you guys, then I can look to do more information on this subject in the coming webinars, if this is interesting. If you're kind of looking at it thinking, no, I'd rather you show me more stuff about technical analysis, then obviously the next webinar will go back to technical analysis. Yeah? I honestly don't know a good one for learning the fundamental approach, Gino, because people like to make things too complicated. It doesn't need to be as complicated as people make out. So yeah, Alex Ong UK, Chris, ALEXONG UK, Alex Ong UK. If you drop us an email, Gino, at support, I'll just quickly type this into everybody. We can send you information on it. As I said, it's not open at the moment, so oops. So I can't. If you send us a link there, then I can give you information on it. But there's no open page at the moment to be able to purchase it or anything like that, because it's closed, and it will be until February, I'm afraid. Okay. So I hope you all have a lovely, lovely day. I hope you all enjoyed this, and I look forward to speaking to you all on the next webinar. Okay? So take care now, and I'll speak to you soon.